In 1928, the richest men in America gathered at a private meeting. Bankers, industrialists, the titans who controlled the money. Within months, every single one of them had quietly converted their stock positions to cash. The newspapers called it diversification. The public kept buying. 12 months later, the stock market lost 89% of its value. 25 million Americans lost their jobs. Banks failed by the thousands. Fortunes built over generations vanished in weeks. The men who attended that meeting, they emerged wealthier than before. Now look at 2024. Warren Buffett is sitting on $325 billion in cash, the largest hoard in corporate history. Jeff Bezos sold $13 billion in Amazon stock. Mark Zuckerberg dumped billions in Meta shares. Jamie Dimon, CEO of the largest bank in America, sold stock for the first time in 18 years. They're not diversifying. They're leaving, and they're not telling you why. What do the richest people in the world see that you don't? What pattern are they recognizing that has played out before every major financial catastrophe in the last century? And why does every indicator suggest that what's coming will be worse than 1929 and 2008 combined? There's a sequence that repeats before every major financial collapse. Not similar, identical, extreme valuations, excessive leverage, a triggering event, forced liquidation, panic. It happened in 1929, it happened in 2008, and every warning sign says it's happening right now. But 2025 is different, and not in the way Wall Street wants you to believe. In 1929, stocks crashed 89% over 3 years. Unemployment hit 25%. It took a quarter century for markets to recover, but only 10% of Americans owned stocks. The devastation was selective. In 2008, the housing market collapsed. Stocks fell 57%. The government spent $2 trillion on bailouts. The Federal Reserve printed money, slashed rates to zero, and expanded its balance sheet from $800 billion to $4 trillion. It worked. Markets recovered in 5 years. But those tools, the rate cuts, the money printing, the bailouts, they weren't free. They created the bubble we're living in right now. Today, the Federal Reserve can't cut rates to zero. They're already low. They can't print unlimited money without reigniting the worst inflation in 40 years. The government can't bail everyone out. It's drowning in $36 trillion of debt. And for the first time in recorded history, stocks, bonds, and real estate are all overvalued simultaneously. The traditional safe havens don't exist anymore. When the collapse comes, there's nowhere to hide. This isn't prediction. This is pattern recognition. The same pattern that is repeated before every major crash in the last century. The same pattern the billionaires are seeing right now. The same pattern that history says ends only one way. The question isn't whether it will happen. The question is whether you'll see it before it's too late. Crashes don't happen randomly. They follow a mechanical sequence, as predictable as gravity. And once you understand the sequence, you'll never look at markets the same way again. Every major crash in the last century has followed 5 stages. Not approximately, exactly. Stage 1 is the bubble. Asset prices rise to levels completely disconnected from reality. In 1929, stocks traded at absurd multiples. In 2000, companies with no revenue were valued in the billions. In 2008, houses in Las Vegas cost more than mansions in Manhattan had a decade earlier. The prices make no sense, but everyone keeps buying because prices keep rising. Stage 2 is euphoria. Everyone believes prices will rise forever. In 1929, shoeshine boys gave stock tips. In 2000, dentists quit their practices to day trade tech stocks. In 2008, strippers owned 5 investment properties. The phrase is always the same. This time is different. It never is. Stage 3 is maximum leverage. When prices rise, borrowing amplifies gains, so everyone borrows. In 1929, investors put down 10% and borrowed 90%. In 2008, banks leveraged 30 to 1. Today, margin debt sits near $950 billion. Options trading by retail investors has exploded. The leverage is everywhere. Hidden in derivatives, embedded in ETFs, scattered across the shadow banking system. Stage 4 is the trigger. Something causes prices to fall. It almost doesn't matter what. A fraud exposed. An earnings miss. A geopolitical shock. The specific catalyst is irrelevant. What matters is what happens next. Stage 5 is forced liquidation. This is where crashes become catastrophic. When leveraged investors face losses, they receive margin calls. They must sell to cover their loans. That selling drives prices lower. Lower prices trigger more margin calls. More margin calls force more selling. It's a death spiral that feeds on itself. This is why crashes happen fast, not gradually, violently. Prices don't decline in an orderly fashion. They collapse in liquidation waves as forced selling overwhelms the market. In 1929, the Dow fell 25% in 2 days. In 1987, it fell 22% in a single session. In 2008, Lehman Brothers went from functioning investment bank to bankruptcy in a week. The pattern is mechanical, predictable, inevitable once the preconditions are set, and right now in 2025, all 5 preconditions are present simultaneously. After every crash comes the same question: how long until we recover? The answer depends on the tools available, and the tools are gone. After 1929, the market took 25 years to return to its previous peak. 25 years. An investor who bought at the top in 1929 waited until 1954 to break even. An entire generation lost. After 2008, recovery took 5 years. But that recovery was purchased with unprecedented intervention. 0 interest rates for 7 years. Quantitative easing that created trillions. Government bailouts that added trillions more to federal debt. The Fed and Treasury threw everything they had at the crisis. It worked, but it created the bubble we're in now. Japan offers the most chilling comparison. In 1989, the Japanese stock market peaked at nearly 39,000. Then it crashed, and it kept falling. By 2003, the Nikkei had lost 80% of its value. The recovery, it took 34 years. The Japanese market didn't return to 1989 levels until 2024. An entire generation of Japanese investors never recovered their wealth. They saved diligently, they invested prudently, and they spent their entire adult lives waiting to break even. America in 2025 faces worse fundamentals than Japan in 1989. The Fed has no tools remaining. Interest rates can't go much lower. The balance sheet can't expand much further without destroying the currency. The government has no borrowing capacity for massive stimulus. Demographic headwinds, an aging population, declining birth rates will drag on growth for decades. Realistic recovery timeline, 10 to 20 years. Some wealth may never recover. The investors who bought at the top in 2024 and 2025 may spend the rest of their working lives waiting to break even, just like 1929, just like Japan. The pattern doesn't change. History doesn't repeat, but it rhymes. And right now, it's rhyming with 1929. The pattern has played out 4 times in the last century. 1929, 1987, 2000, 2008. Each time, the sequence was identical. Extreme valuations, excessive leverage, a triggering event, forced liquidation, panic. Each time, the warning signs were visible for months before the collapse. Each time, most people ignored them. They believed it was different. They believed new technology had changed the rules. They believed the Fed would save them. They believed valuations didn't matter anymore. They were wrong, every single time. The billionaires aren't wrong. Warren Buffett is sitting on $325 billion in cash, the largest hoard in corporate history. The greatest investor of all time can't find anything worth buying. His own indicator screams that stocks are dangerously overvalued. He's waiting. Jeff Bezos sold $13 billion in Amazon stock. The company he built from a garage. The company he knows better than anyone on earth. He's out. Mark Zuckerberg dumped billions in Meta shares. Jamie Dimon sold stock for the first time in 18 years. Nvidia insiders are selling at record levels while their stock hits all-time highs. These men have access to data you'll never see. They know real earnings, real customer trends, real problems before anyone else. And they're all doing the same thing at the same time. They're leaving. They see what's coming. The same pattern that has repeated before every major crash. The same indicators that have never been wrong. The same sequence that ends only one way. But this time is worse. In 1929, only 10% of Americans owned stocks. In 2008, the government had borrowing capacity and the Fed had tools to deploy. There were safe havens. There were escape routes. In 2025, 58% of households own stocks through retirement accounts. The Fed has exhausted its ammunition. The government is drowning in $36 trillion of debt. Stocks, bonds, and real estate are all overvalued simultaneously. There is no safe haven. There is no cavalry coming. There is nowhere to hide. The crash window is open. Late 2025 through 2026. The yield curve says recession is imminent. The insider selling says smart money has fled. The valuations say the fall will be catastrophic. Most people will be caught holding stocks at the top. They'll watch their retirement accounts collapse. They'll wonder how they missed the signs. The signs were everywhere. They just didn't want to see them. Joseph Kennedy saw the pattern in 1929. He converted to cash while everyone else was buying. When the crash came, he was protected. When the bottom arrived, he bought everything at pennies on the dollar. His fortune funded a dynasty. The pattern is the same. The question is the same. Do you see it? Or will you be the one wondering what happened after it's too late? The Roaring Twenties were supposed to last forever. Between 1924 and 1929, the stock market tripled. New technologies, radio, automobiles, electricity, were transforming American life. Factories hummed, skyscrapers rose, fortunes were made overnight. The newspapers declared a new era of permanent prosperity. Everyone was buying stocks, factory workers, school teachers, barbers, and they weren't just buying with savings, they were borrowing. Margin debt hit record levels. Investors put down 10% and borrowed the other 90%. A $1,000 investment could control $10,000 worth of stock. When prices rose, the gains were spectacular. But leverage works both ways. Joseph Kennedy, father of the future president, was one of the most aggressive speculators of the decade. He'd made millions manipulating stock prices through coordinated buying schemes. By early 1929, Kennedy controlled significant positions across multiple companies. Then something changed. In the summer of 1929, Kennedy began quietly converting his stocks to cash. Not all at once, and that would move markets, but steadily, systematically. By September, he was substantially out. The story goes that Kennedy decided to sell after a shoeshine boy gave him stock tips. If the shoeshine boys were buying, there was no one left to buy. And without new buyers, prices could only go one direction. The Dow Jones peaked on September 3rd, 1929 at 381. 7 weeks later, the crash began. October 24th, Black Thursday. The market fell 11% at the open. Bankers pooled money to stabilize prices. It worked temporarily. Then came Black Monday and Black Tuesday. In 2 days, the Dow fell 25%. By mid-November, it had lost 40% from its peak. But the real devastation was just beginning. The crash triggered margin calls across America. Investors who had borrowed to buy couldn't cover their losses. Brokers sold their positions at any price. That selling drove prices lower. Lower prices triggered more margin calls. The death spiral accelerated, and by 1932 the Dow had fallen 89%. A $10,000 portfolio was worth $100. Banks failed by the thousands. Savings accounts vanished. Unemployment hit 25%. Bread lines stretched around city blocks. It took 25 years, until 1954, for the market to return to 1929 levels. But here's what most people don't understand about 1929. Only 10% of American households owned stocks. The vast majority watched the crash from the sidelines. They suffered later through unemployment and deflation. But the initial collapse didn't directly destroy their savings. Today, 58% of American households own stocks through 401ks, through IRAs, through pension funds. When the next crash comes, it won't affect 10% of America. It will affect everyone. Joseph Kennedy emerged from the Depression wealthier than before. He bought assets at the bottom when everyone else was selling. His fortune funded a political dynasty. The men who see the pattern always survive. The question is, do you see it? The 2008 financial crisis was supposed to be a once-in-a-generation event. The kind of catastrophe that reshapes regulations, reforms institutions, and teaches lessons that last a lifetime. Instead, it was a dress rehearsal. The housing bubble inflated for years in plain sight. Between 2002 and 2007, home prices doubled in many American cities. They were all wrong. The machinery of destruction was subprime lending. Banks gave mortgages to people who couldn't afford them. No income verification, no down payment, adjustable rates that would explode after 2 years. The banks didn't care. They packaged these mortgages into securities and sold them to investors worldwide. By the time the loans defaulted, the banks had their money. Lehman Brothers was leveraged 30 to 1. For every dollar of capital, they held $30 in assets. This magnified profits spectacularly. But it also meant a 3% decline in asset values would wipe them out entirely. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in American history. $600 billion in assets, gone overnight. The financial system froze. Banks stopped lending to each other. Credit markets seized. Companies couldn't make payroll. The economy stood at the edge of complete collapse. And then the government intervened. The Federal Reserve slashed interest rates to zero. They launched quantitative easing, creating trillions of dollars to buy toxic assets from banks. The Treasury deployed TARP, the $700 billion bailout fund. Additional programs pushed total intervention close to $2 trillion. As it worked, the bleeding stopped, markets stabilized. By 2013, stocks had recovered their losses. But the rescue wasn't free. The Fed's balance sheet ballooned from $800 billion to over $4 trillion. Interest rates stayed at zero for 7 years. The government borrowed massively to fund stimulus programs. Federal debt climbed from 67% of GDP to over 100%. The tools that saved us in 2008 created the bubbles we face today. Zero interest rates inflated stock prices. Quantitative easing pumped liquidity into every asset class. Cheap borrowing fueled corporate debt binges and real estate speculation. And here's what terrifies economists who remember 2008. Back then, the government had borrowing capacity. Federal debt was manageable. The Fed had room to cut rates. The balance sheet could expand. Today, none of that exists. Federal debt has hit $36 trillion. The Fed's balance sheet already sits at $7 trillion. Interest rates can't go much lower without reigniting inflation. The tools that saved us in 2008 have been exhausted. When the next crisis hits, there is no cavalry coming. Every previous crash had a safe haven. In 1929, bonds held their value while stocks collapsed 89%. Investors who fled to treasuries preserved their wealth. In 2008, when housing and stocks cratered, government bonds rallied. Money fled to safety, and safety existed. In 2025, there is no safety. For the first time in recorded financial history, stocks, bonds, and real estate are all overvalued simultaneously. The traditional refugees have become traps. And when the collapse begins, there will be nowhere to hide. Start with stocks. Warren Buffett has called the Buffett indicator the single best measure of market valuation. It divides total stock market capitalization by GDP. Anything above 100% is overvalued, above 120% is dangerous, above 150% is bubble territory. The Buffett indicator currently sits at 185%. The stock market is valued at nearly twice the entire economic output of the United States. This level of overvaluation has only been exceeded once, during the COVID money printing frenzy. Before the dot-com crash in 2000, the ratio peaked at 140%, we're 45 points higher. The Shiller PE ratio tells the same story. This metric measures stock prices against 10 years of average earnings, adjusted for inflation. The historical average is 16. Before the dot-com crash, it hit 44. Before the 2008 crash, it reached 27. Today is 34, the third highest reading in history. But valuation isn't the only danger. Concentration is. 7 stocks: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla represent 30% of the entire S&P 500. Nvidia alone accounts for 7% of the index. Its price-to-earnings ratio exceeds 65. Investors are paying $65 for every dollar of profit. This concentration hasn't existed since 1929. When those 7 stocks fall, they take the entire market with them. Now look at real estate. Home prices sit 50% above their long-term historical trend relative to income and rent. At the peak of the 2008 housing bubble, the bubble that nearly destroyed the global financial system, homes were 35% above trend. The current bubble is 43% larger than 2008. But residential real estate is only half the crisis. Commercial real estate is already collapsing. Office buildings across America sit 40 to 50% vacant. Remote work isn't a pandemic trend. It's permanent. Companies that leased 5 floors now lease 2. San Francisco's commercial vacancy rate has hit 35%. These buildings were financed when interest rates were 3%. Now those mortgages are maturing. Owners must refinance at 7 to 9%. The math is simple. A building that barely generated enough income to service debt at 3% cannot survive at 8%. Over $2 trillion in commercial mortgages mature through 2025 and 2026. A significant portion cannot be refinanced. The owners will default, they'll hand the keys to the lender and walk away. This is already happening. Brookfield Asset Management defaulted on Los Angeles office towers. Blackstone has faced redemption requests it cannot meet. The smart money is fleeing. And then there's the bond market. Government bonds were always the safe haven, the asset you held when everything else crashed. In 1929, bonds preserved wealth. In 2008, treasury prices surged as investors fled to safety. But in 2025, bonds are crashing alongside stocks. The federal government owes $36 trillion. Interest payments alone exceed $1.2 trillion annually, larger than the defense budget. The government must issue trillions more in bonds just to cover deficits and refinance maturing debt. When supply overwhelms demand, bond prices fall and yields spike. Higher yields mean higher interest payments. Higher interest payments require more borrowing. More borrowing requires more bonds. It's a doom loop with no exit. Stocks overvalued at historic extremes. Real estate more inflated than 2008. Bonds crashing under the weight of unpayable government debt. 3 bubbles, simultaneous, interconnected. When one breaks, they all break, and for the first time in history, there is nowhere left to run. The indicators that predicted every major crash in modern history are all flashing red. Not 1 or 2, all of them. Simultaneously, the yield curve. This is the most reliable recession predictor in existence. When short-term interest rates exceed long-term rates, recession follows within 12 to 24 months. The yield curve has predicted every recession since 1950. No false signals. It inverted in July 2022 and stayed inverted for 27 months before normalizing in September 2024. Historical pattern says recession arrives 3 to 12 months after normalization. The clock is ticking. Insider selling. Corporate executives have access to information you'll never see. They know real earnings, real customer data, real problems before anyone else. In 2024, insider selling hit $464 billion, the second highest year on record. The highest was 2007 at $650 billion. We know what followed. The sell-to-buy ratio spiked to 9 to 1. Insiders are selling $9 for every dollar they buy. This isn't diversification. This is evacuation. Buffett's cash. Warren Buffett is sitting on $325 billion in cash, the largest cash position in corporate history. He's been selling stocks, including reducing his massive Apple position and buying treasury bills. When asked why, he said valuations are too high. He can't find anything worth buying. The world's greatest investor is waiting for the crash. Consumer debt. Credit card balances have hit $1.14 trillion. The average household carries $6,800 at interest rates exceeding 21%. Delinquencies. Borrowers 90 days or more behind have risen to levels not seen since 2011. American consumers are tapped out. Auto loans. Delinquency rates have spiked to 7.5%, the highest since 2009. Average monthly payments exceed $740. Loan terms have stretched to 84 months, 7 years to pay off a depreciating asset. This is subprime lending with a different name. Commercial real estate. Brookfield defaulted on office towers. Blackstone can't meet redemption requests. Over $2 trillion in mortgages mature through 2026. The smart money is walking away from buildings they can't refinance. Regional banks. Silicon Valley Bank, First Republic, Signature Bank. 3 failures in 2023. And we weren't even in recession. These banks held commercial real estate loans. More failures are coming. Margin debt, nearly $950 billion borrowed to buy stocks. When prices fall, margin calls force selling. Forced selling accelerates decline. The leverage that amplifies gains will amplify losses. Unemployment. The SAM rule states that when unemployment rises 0.5 percentage points above its 12-month low, recession has begun. This rule has never been wrong. We're approaching the trigger threshold. Student loans, $1.77 trillion in debt. Payments resumed after a 3-year pause. Defaults are surging. An entire generation services debt instead of building wealth. Federal debt, $36 trillion and climbing. Interest payments exceeding $1.2 trillion annually. The government borrows money to pay interest on previous borrowing. The definition of a death spiral. Geopolitical risk. Ukraine, the Middle East, Taiwan. Any could trigger the cascade. 12 warning signs, all flashing simultaneously. The pattern has never been clearer. The crash isn't coming in some distant future. The timeline is measurable, predictable, and terrifyingly close. Historical pattern provides the framework. In 2007, insider selling peaked between January and September. The stock market topped in October. The crash began immediately after. 12 months from peak selling to collapse. Now apply that pattern to today. Insider selling hit record levels throughout 2024. If history repeats, and it always does, the crash window opens late 2025 and extends through the first half of 2026. The yield curve confirms this timeline. It inverted in July 2022 and normalized in September 2024. Every recession since 1950 has arrived within 3 to 12 months after normalization. That places the recession window between December 2025 and September 2026, the same window the insider selling pattern predicts. Commercial real estate adds another timestamp. Over $2 trillion in mortgages mature through 2025 and 2026. These loans were written when rates were 3%. They must be refinanced at 8%. The math doesn't work. Defaults will cascade. Banks holding these loans will take losses. Some will fail. The Federal Reserve is trapped in its own timeline. They raise rates aggressively to fight inflation. Now they face a choice. Cut rates and risk reigniting inflation, or hold rates and accelerate the recession. Either path leads to crisis. The only question is which crisis they choose. Could the crash come sooner? Absolutely. A trigger event could accelerate everything. A major tech company missing earnings, a geopolitical shock, a bank failure that spreads contagion. The system is so fragile that any unexpected shock could start the cascade tomorrow. Could it come later? Possibly. Markets can remain irrational longer than anyone expects, but the fundamentals don't change. The debt doesn't disappear. The valuations don't become reasonable. The leverage doesn't unwind itself. The window is clear. Late 2025 through 2026, 18 months at most. The billionaires have already positioned themselves. The question is, will you? The crash won't announce itself. There will be no warning bell. No headline that says sell everything today. It will begin with something that seems manageable, contained, and then it will accelerate faster than anyone thought possible. Phase 1, the trigger. It could be anything. A tech earnings miss that shatters the AI narrative. A commercial real estate default that cascades through regional banks. A geopolitical shock that freezes credit markets. The specific trigger almost doesn't matter. The system is so over-leveraged, so fragile that any significant shock will start the sequence. Imagine Nvidia misses earnings projections. The stock that represents 7% of the S&P 500 suddenly looks overvalued at 65 times earnings. Algorithmic trading systems, programmed to sell on negative signals, execute instantly. The stock drops 15% in a single day. Because Nvidia is 7% of the index, that alone drags the S&P down nearly 1%. But the real damage is psychological. If Nvidia's AI story cracks, investors question every AI valuation. Microsoft, Amazon, Google, Meta. The Magnificent Seven that carry 30% of the market suddenly look vulnerable. Within days, all 7 are down 20 to 30%. The index follows. Phase 2, margin calls. This is where decline becomes collapse. Investors who borrowed to buy stocks face margin calls. The brokers demand additional collateral. If they can't provide cash, the broker sells their positions automatically. The forced selling drives prices lower. Lower prices trigger more margin calls. More margin calls force more selling. The death spiral has begun. In 1929, margin calls turned a market correction into an 89% crash. In 2008, forced liquidation transformed a housing decline into global financial meltdown. The leverage that amplified gains on the way up now amplifies losses on the way down. Within the first month, stocks could fall 30 to 40%. Phase 3, credit crisis. The cascade spreads from stocks to bonds. Investors flee to treasuries, but the government needs to issue trillions more. Supply overwhelms demand. Bond prices fall, yields spike. Corporate borrowers who need to refinance debt face rates they cannot afford. Defaults surge. Regional banks holding commercial real estate loans realize massive losses. Capital ratios fall below regulatory minimums. Regulators close the weakest banks. Depositors at other regional banks panic. Bank runs spread. Phase 4, maximum panic. Unemployment spikes from 4% to 9%, then 12%. Companies freeze hiring, then start layoffs. Consumer spending collapses. Businesses fail by the hundreds of thousands. Headlines predict the end of capitalism. This is the bottom, but most people won't recognize it. They'll be too busy selling. The Federal Reserve saved the economy in 2008. They cut interest rates to zero. They printed trillions through quantitative easing. They bought toxic assets from failing banks. They expanded their balance sheet from $800 billion to over $4 trillion. It worked. The financial system survived. But the Fed spent its ammunition, and now it faces a crisis with an empty chamber. Option 1. Print money. The Fed could launch another round of quantitative easing. Create trillions more dollars. Buy government bonds. Inject liquidity into failing markets. This is the 2008 playbook. The 2020 playbook. But everyone remembers what happened last time. After COVID, the Fed printed over $4 trillion in 2 years. More money created than in the previous century combined. Inflation exploded to 9%, the highest in 40 years. Grocery prices jumped 25%. Housing costs soared. The average American watched their purchasing power evaporate. If the Fed prints again, inflation returns, the dollar weakens, the cost of everything rises. The very people the Fed claims to protect get destroyed by the currency debasement meant to save them. Option 2, let it crash. The Fed could refuse to intervene. Let markets find their natural bottom. Let over-leveraged investors and reckless corporations face consequences. Let the system purge its excesses. The result would be depression. Unemployment spiking to 15% or higher. Banks failing in waves. Businesses collapsing. Retirement accounts devastated. A decade of economic stagnation. Political and social instability that could tear the country apart. The trap. There is no good option. The Fed's balance sheet already sits at $7 trillion. Interest rates are already relatively low. There's minimal room to cut without going negative. Federal debt has reached 125% of GDP. The government has no borrowing capacity left for massive bailouts. The tools that worked in 2008 don't work in 2025. Print money and destroy the currency. Don't print and watch the economy collapse. The Fed will be forced to choose. Neither choice ends well. In 1929, only 10% of American households owned stocks. The crash devastated Wall Street, but most Americans watched from a distance. Their suffering came later, through unemployment, through deflation, through the slow grind of depression. In 2025, there is no distance. 58% of American households now own stocks, not through brokerage accounts and stock tips, through retirement accounts, through 401ks and IRAs, through pension funds that invested their futures in the market. When the crash comes, it will hit everyone. Retirement accounts. The average American with a 401k will watch decades of savings evaporate. They can't retire. They have to work another 10 to 15 years, assuming they can keep their jobs through the recession. Those already retired face something worse. They're forced to sell stocks at the bottom just to pay bills. They lock in losses, they'll never recover. Their income disappears precisely when they can't replace it. Homeowners. Anyone who bought a house between 2021 and 2024 will find themselves underwater, owing more on their mortgage than their home is worth. Unable to sell without bringing money to closing. Trapped in properties they can't afford as unemployment rises and income falls. The foreclosure wave will mirror 2008, except this time, housing is even more overvalued. Young workers. The graduating classes of 2026 and 2027 will enter the worst job market since the Great Depression. No entry-level positions. Hundreds of applicants for every opening. Studies of the 2008 recession showed graduates who entered during the crisis earned less for their entire careers. The coming crash will be worse. The scarring will be deeper. Small businesses, consumer spending will collapse. Credit will vanish. The local restaurant, the family retail shop, the neighborhood service business. Hundreds of thousands will fail. The economy that emerges will be dominated by massive corporations. Small business will be a memory. The middle class, 40 years of savings, gone. No ability to buy at the bottom, no resources to weather the storm. The wealth gap won't just widen, it will become a canyon.